So let's backtrack real quick. So again, on the exam for chapter 1, you definitely need to know what the nature of a business is. You definitely need to know at least the idea behind the 5 different organizations, okay? I'm not going to test you on specific information such as what each one is created or how they are created and why they are created. I just need you to be able to recognize that there are 5 that exist here, okay? And the one that we are primarily focusing on is sole proprietors, small businesses, okay? Again, you do definitely need to know the definition between a bookkeeper and the accountant, and definitely understand the definition of accounting. All right, you definitely need to know the difference or what the definition entails, such as summarizing, sorting, recording, analyzing. You need to know all of those information, or at least the definition of accounting, because I will test you on that. You definitely need to know the 3 major business activities, which is the service, manufacturing, and merchandising. And for sure, the 4 statements, the 4 state financial statements are the most important thing, because at the end of this class, we will learn and we will complete all 4 statements to in this class. So it's important that you know each and every single one of them. Okay. And then, of course, the areas of accounting, which I've mentioned before. You need to know the difference between each one, but I'm not going to test you on specifics like what kind of job areas are available in public accounting. I'm not going to ask you that. I'm just going to ask you what are the 5. I could ask you what are the 5 different areas of accounting, and which one, which one which one does each one represent. So public accounting is for publicly traded companies such as corporations. Private accounting, once again, is for smaller businesses. Okay. Government is for government agencies. Okay. Nonprofit is straightforward, is for nonprofit organizations. And last but not least, international is once again for any businesses that want to do business overseas, which in this case, right, for us, we are only doing strictly accounting in the United States. Okay, this is the 101 of accounting. Before you even get into those other areas of accounting, you still need to know at least the basic fundamentals of how accounting works. Okay? So that's chapter 1 wrapped up. Okay? Now, chapter 2, you will need to know, once again, the definition of accounting. You do need to know the accounting equation, because I will ask you to compute a question that revolves around the accounting equation. Okay, you definitely need to know which accounts normally have a debit balance or have a credit balance. You need to know the difference between debits and credits and why they're not increase and decrease, right? It just literally means left or right, because depending on what account type you are looking at, right? There are 5 account types: assets, or liabilities, equity, revenues, and expenses. You need to know how each one flows in a transaction, meaning you need to know the accounting model, which I've already provided the sheet for you, right? Which accounts are normally increased by a debit and which ones are increased by a credit, okay? And you need to know the definition of the normal balance. It's whichever side that is increased on the positive side for. So, for example, the normal balance of an asset would be a debit. You are required to need to know this, because if you guys remember from the chapter 2 exercises, I ask you an account, and I'm going to ask you to I'll give you a description of what that account is, and your job to me is to determine the account type, the account category, and what normal balance each account will have, okay? And that will be the first 10 questions of your exam, okay? So it's going to be similar to our exercises, so we'll go ahead and practice that today. So that's going to pretty much be a big, huge chunk of chapter 2 because it's teaching you how the normal balance is, how to figure out what account type there are. And of course, the next section here is determining what the categories are for each account. So again, assets only have 3, which are your current, your fixed, which is also known as PP&E, which is your property, plant, and equipment, and other assets, okay? Your liabilities, there's only 2, current and long-term. Equity, there is no categories, okay? I will ask you again on this exam. And then for income or revenues, whichever one you want to use, right? There's operating, other / non-operating. Okay? And again, for expenses, there's cost of goods sold, operating expenses, and non-operating expenses. So these are very important because, again, I will be giving you a scenario where I will give you an account, I'll give you the description, and you need to determine the account type, the category, and the normal balance. So that is what your task is for chapter 2. Okay, and also I will give you to figure out what the accounting equation is. Okay. For chapter 3, as far as chapter 3 goes, I'm only going to test you basically on practicing how to journalize. So chapter 3 kind of expands into chapter 5 because I will be asking you questions to journalize how to journalize periodic inventory. So again, that's going to be your practice for this test right here, is that I gave you a bunch of blank general journals, and what you're trying to do here is you're going to have to figure it out on your own, and I will give you multiple choice questions in regards to, for example, A, debit purchase expense for X amount, and letter B will be credit purchase expense for X amount, right? You need to be able to determine which letters is going to complete your journal entry, okay? And I will also test you, I believe the last question in your exam is going to be, or the last questions is going to be in regards to completing an error, or to correct a journal entry that you made an error on, okay? I'm not going to test you on the ledger just yet, just because, right, that's something that we will learn in the fictitious business. However, just know the concept or what the difference is between the journal and the ledger is definitely important. And then chapter 4, okay, chapter 4 is a long one. It's a huge one, right? You will be required to know the exact order of the accounting cycle, all right? Just knowing the steps is not enough. You need to know the exact order of the steps, because in this case, when we do complete the end of this course, we will be actually completing the accounting steps from 1 through 10, all right, in that exact order. So when I can ask you a question in regards to knowing the exact order of, or what represents the accounting cycle. So you need to make sure that it's in the order of this sequence right here, where the first thing that you got to do is collect your source document. Second thing is you got to analyze and sort the information. Third thing is you're going to journalize it in your journal, or record the transaction in your journal. Then the fourth is to post it to the general ledger. Fifth is to complete a unadjusted trial balance. 6 is to complete your adjustments. 7 is to do an adjusted trial balance. And then 8 is to do to create your financial statements. 9 is to close up your books, and 10 is to post your post-closing trial balance. Now, I'm not going to require you to know what each step is in detail, because I'm not going to require you to know what the steps are to close out your books. No, I just need you to know the very basics, which is just understanding how the accounting cycle works and what the steps are. Okay, not what each step is in details, because for now, this class, for the next 10 weeks, we're only going to be taking a look at steps 1 through 3. Once we reach the fictitious business, that's where we'll start diving into the rest of the accounting cycle. So doing steps 4 through 10. Okay, so in this case, like I've mentioned before, you only need to know what the steps are and what order they belong in. Okay? And then, of course, the accounting period, right? You definitely need to know the definition, which is to when you are going to schedule to complete the accounting cycle. You need to know an example of an accounting period, which is daily, weekly, monthly, quarterly, right? It's just broken into time frames that makes it much easier to measure profitability. Okay, and calendar versus fiscal year, right? The difference between them is straightforward, right? The calendar year is when you have from January 1st to December 31st, where fiscal year is any 12 consecutive months where you start on the first of the first month and you end on the last day of the last month, of the 12th month. Okay? You need to know the 4 characteristics of financial statements, because once again, these key components are what makes accounting, or the reason why we produce the financial statements, right? We talked about this in chapter 1, where the reason why we produce these financial statements is for our external and our internal users. So in order to have proof that a transaction has occurred, you need to make sure that the information is reliable, consistent, comparable, and relevant. Okay. All right, and then I'm gonna ask you a couple questions in regards to Acct, right? So you need to know the definitions. Okay. Now, in this case, I've mentioned this before, I am only going to be testing you on the first 8 accounting principles, okay, or the Acct, okay? I am not going to test you on constraints or conservatism, okay? Because, once again, this one is more geared towards profit managers or cost managers, excuse me. So in this case, in this class, we're more geared towards the first 8 accounting assumptions and the principles. The concerns and constraints, those ones are more for cost accounting, and they go beyond the I guess the spectrum of this accounting, right? This is more at level advanced, where you have to kind of consider, right, what decisions will affect the business, right? That is going to be something that's for level higher of accounting. Okay, so I'm only going to test you on the first 8, which is going to be your assumptions and your principles. Okay, however, that doesn't mean, even though I'm not going to test you on the constraints or concerns, you do need to know at least their titles, like what the constraints are, in regards to being able to list them. Okay. All right. And then last but not least, being able to determine the difference between a cash basis of accounting and an accrual basis of accounting, right? Cash basis is when you recognize revenues when cash is received, and you recognize expenses when cash is readily available to spend, okay? So if you guys remember, if you need to, chapter 4, there's an example of a cash basis versus accrual basis in a scenario that I've given. So with that being said, right, you only recognize on a cash basis if there's cash that's being received, like actual physical cash, okay? Where an accrual basis doesn't care whether you receive cash or not. They're more concerned about just earning that revenue. So if something has been sold or a job has been completed or service has been completed, right? That's going to be considered something that you've earned. You've earned your revenue. So therefore, you're going to record it regardless whether you receive cash or not. Okay? Same thing goes with to expenses as well. You will record the expense as soon as whatever that expense is, whether you had a job that was completed for you or you had to purchase something, you will record that expense the day it occurs. So in this case, it's going to be incurred. Okay? All right? Being able to know the difference between the cash and accrual basis, because I will ask you on that exam. Okay? So again, tomorrow we'll pick up on chapter 5 and chapter 6. Okay? So let's go ahead and dive right into the study guide here. Okay? If you need to have those review sheets readily available so you're able to help answer the questions or whatever you need to do so. Okay. All right, so number 1, okay, what is accounting? A, the process of recording, sorting, and summarizing all business transactions and events. Good. Okay, so B says the process of creating formulas. No, that's not true. The process of elimination. That's not true. And the process of collecting data from all business. Okay, that only answers half the question of what accounting is. The real important is that you want to analyze it and you want to be able to sort the information. So A is correct. Okay. Number 2. Which of the following areas of accounting does financial, managerial, and financial planning and treasury accounting belong to? B, right? Private accounting. Okay. All right. Number 3, okay? Which of the following is not a business organization? D, all of the above are business organizations. Yes, that's correct. Okay. Number 4, okay, which of the following financial statements is based on the accounting equation? Okay, where your assets equals your liabilities and your equity.
A, your balance sheet.
Yes. Okay, we talked about at least knowing why each one is being made, right? Which is something that I need you guys to know because it's important because at the end of this class, we are going to complete each one. So the profit and loss is obviously not going to test the accounting equation, right? In this case, if you kind of break down the wording in this balance sheet, you have an equation, right? If your assets are balanced with your equity and your liabilities, okay, that will give you the biggest hint right there. Okay. Number 5, what is the difference between the accountant and the bookkeeper?
A.
Right. The accountant is the one who records, creates financial statements, and analyzes the transactions, okay? While the bookkeeper only records business transactions, okay? Right? It's not the other way around. So here's the part, chapter 2, that I was talking to you guys about. What your responsibility here for this chapter is to be able to, one, I will give you an account. I will give you a description of what the account is, and your job is to determine the account type, the account category, and the normal balance. So here I have the options for you. When you are taking your exam, they will be broken into individual ones, right, with a description on it, so it will look exactly like the exercises. And so it will have a column for the account name, a column for the description, and then it will have 3 blank columns: the account type, category, and normal balance. Your job here is that I will give you A, right? Example here. A, assets, other, debit. B, assets, current, debit. And then C would be expense, other, credit. Okay, so that's the options I'm going to give you. So I'm going to pretty much give you a little hints in each one, but out of all of the options, just choose the one that is the most correct. Okay, obviously there's only one correct answer for each one, so please do your best to kind of analyze and be sure and confident that this is correct. Okay, so number 1, okay, or in this one, number 1, the account is cash, which is straightforward, right? It's just cash. What kind of account type, category, and normal balance would cash have?
It's an asset.
It definitely is an asset, right? Cash is what you own.
It's a current asset.
And it's current because it's already in its simple liquid form. It's already in its readily available form, which is cash. Right? And what kind of balance would it have? It would have a debit balance. Good. What about an accounts receivable when customers owe you money?
A liability? Or no, an income?
Okay. All right. It's not a liability because customers owe you money, not you owing money to other people. So that's what a liability does, is when you owe to somebody else. So in this case, the customer owes us money. Second thing that is, it's not an income account because, yes, it comes out of generating revenue, right, when you sell an item. However, this is money that other people owe you.
It's an asset.
It is an asset because you own that money that these people owe you. You own them. You're going to go after them and say, hey, you owe me money. That's my money. Right? So in this case, it is an asset because you own these IOUs. Okay? Now, what kind of asset would it be?
It's current.
Definitely current, because if someone owes you money, you can go right to their door and say, hey, you owe me money, give me money now, right? And what kind of balance would it have?
Debit.
It would have a debit balance. Good. Okay. Next one is going to be inventory. What is inventory?
It's an asset.
It is an asset. Good. Now, what kind of asset?
It's current.
Yes, it is definitely current. So in this case, right, inventory are items that we purchase. So when we purchase these items, right, that means we own these items until we turn it around and we sell those items. Okay, so in this case, when we purchase our inventory, we own them. They're our items until we sell it. Now, it is current because we can choose to sell it and turn it around in a matter of minutes, right? Or a matter of days. We can easily convert our inventory items into cash. So it is definitely current. Now, what kind of balance would it have?
Debit.
What about equipment?
Is an asset.
It is an asset. Now, what kind of asset?
A fix.
It is fixed because it falls in the category, right? PP&E, property, plant, or equipment. That's one of the key factors right there. It is equipment. So it's machinery to help operate the business. Okay? Now, in this case, what kind of balance would a fixed asset have?
Is debit.
It is debit, yes, because in this case, right? It's an asset because we own the machinery. Okay? It is a fixed asset because it has the properties that it has a life, and it's going to be considered fixed because you can't really return it around in cash as easily. It's not going to be it's not going to be fast. All right, and it's going to be considered a debit. Good. What about land? What is land?
Would that also be an asset?
That would also be an asset because you would own it, right? Now, what kind of asset would it be?
Long term?
Is there such thing as a long-term asset?
Oh no. A fixed asset?
It would be fixed, right? This would fall under the category of property, right? Property is going to be anything that you own in regards to land. Land, the streets, the sidewalks, the parking lot, anything that is going to be property. Okay. Good. And what kind of balance would this normally have?
A debit as well?
It would definitely have a debit balance, yes. Okay. What about a prepaid account? Okay. I'll give you an example of a prepaid account. Prepaid rent. Advance payments that you've made, all right, in advance for services. Prepaid accounts.
An expense?
It is not an expense. Okay.
It's an asset.
It is an asset.
Oh.
It's very similar to an expense though, because you're probably thinking, okay, rent. Rent is an expense, right? Now in this case, I paid. If you wanted to make that an expense, right? In this case, I already paid for the rent in advance. As in, like if I were to pay rent, right? I paid 4 months in advance. I would recognize the current month as an expense, but whatever I have that I paid in advance for is going to be considered a prepaid account because I've already paid for it. So in this sense, I own that building for the next 3 months because I've already paid for it already. So that's the concept here, is that I own it. Okay. Now, what kind of asset would this be?
Other asset.
It would be other because it technically would be, it has that key characteristics that it's intangible. Okay. Can you touch rent?
No.
No, you can't physically touch rent. So in this case, right, if I made payments for rent in advance, can I be able to physically touch that rent? No, right? You could touch the paper, the contract, but anybody can rip up that contract. But in this case, what is rent? What determines rent as a feature, right? You can't touch rent because the act or the service of rent is not tangible. Okay? And then what kind of account balance would normally be for a prepaid account?
As a debit.
It would be a debit, yes. What about accounts payable when you owe other people money? Right? We've seen accounts payable before when you purchase things from vendors and they allow you to pay on credit where you're not paying them now, but you're telling them that I'm going to owe you money. I'll pay you later. I owe you money.
Is a liability.
It is a liability. Now, what kind of liability?
As current.
Current, definitely, because again, if you're going to owe somebody on an account, most likely you're going to owe within 30, 60, or 90 days, right? Or even 6 months. But there's no way that you're going to pay somebody or you're going to owe somebody for a year, okay, for services, okay? So in this case, what kind of normal balance would it have?
Credit.
Credit. What about an unearned revenue when customers pay you in advance for services? Unearned revenue when customers pay you in advance for services.
Would that be an income?
Okay, so let's look at this carefully. When a customer paid you in advance for a service you haven't completed yet. In this case, can you recognize it? You haven't completed the service yet. So it can't be income. Because revenues, right, is when you earn your when you earn money by doing a service or by providing a product or selling a product. In this case, this hasn't been earned yet. Customers have already paid you in advance, but you haven't completed the task yet.
Is a liability.
Yes, it is, right? Because you owe the customer service now. So remember, liabilities are when you owe other people, okay? It doesn't necessarily strictly mean owe vendors. It can constitute as well as owing customers. And unearned revenue is a good example of owing to your customers, right? They already paid you money in advance for a service you haven't completed yet. So therefore, you are are obligated to provide the service. So would it be current or long term?
Both.
In this case, it most likely be current because if you are a customer and you paid somebody to do a job for you and you wait a whole year for that, wouldn't you be upset? So most likely it's going to be more than likely current, right? You don't pay somebody in advance and expect them to give it back, give it to you, provide you service a year later. Okay. Now, yes, there are a few services that are out there, but most likely it's within a year. I don't think I've ever seen anybody pay something that happened a year later, unless it's like rescheduling issues. Okay. So there you go. Now, what kind of balance would unearned revenue have?
It's credit. But when you say about the earned revenue, you say that it can be a loan or a mortgage or something like that. It can be something in the long term too. It's not something that it can be something like that. Oh, I don't know. Or I didn't
Well,
understand so well.
in this case, unearned revenue is when a customer pays you in advance for services. As a customer standpoint, you paid somebody to do a paint job and they don't do it for a year later, would you accept that?
It can be a project, no? That you have a many. I don't know. You explained that it can be both. So I don't remember exactly, but it can be a project, a long term, or something like that. Sorry.
In most cases, if a customer has paid you and it's a long-term project, most likely you're going to have split payments for that. But in this case, a paint job is not going to take more than a year.
So most of the time is a current one, right?
Most of the time it would definitely be current because again, if a customer paid you for services, they're not going to wait. They're not going to be willing to wait a year.
No.
Yeah.
I
So
think so.
most likely it will be most often be a current liability. Okay.
Okay.
It's only those
Mhm.
very few, like if it is a project, they'll most likely have require you like a down payment or something like that. If you're a company and you're trying to build a building, that's a different situation because you're building a building. That's not going to be able to be happen within a year. It can be done in a year, but most cases it's never done in a year. Okay? And those are special circumstances where um, they're then in that case they would most likely not pay you for the whole entire service. They'll pay you for a portion of the service. But in most cases, those that something like that, if you're building a building, then yes, that will be one of those special circumstances. But we're talking about merchandising inventory, right? We're talking about merchandising, selling a product or providing a service. More than likely, it is going to be current. No one's going to pay you to ship them out coffee and have to wait a whole year for that. You know what I mean? Okay. What about a
Thanks.
loan payable?
It's a liability too.
It is a liability. Now, what kind of liability?
It's a long or long or. or short time. It depends. It can be current. It can be long time. No, long term.
In this case, most likely loans are long term, right? Unless it specifically says it's a short term loan, then yes, right? But most cases, minimum of a loan is usually a year later, okay? And the determining long term versus current is if you owe more than a year, then it's going to be long term. Now, in case most loans, business loans, are easily 3 to 10 years, where home loans, right, or property loans are anywhere from 36 to 40 years. So in this case, right, most than likely, most loans are going to be at least a year long. Okay. Unless it's specified as a short-term loan, which oftentimes that's kind of rare to see, a short-term loan, right? You know, if that's the case, it's kind of like an advance payment. But in this case, a short-term loan could easily be as far as six to 9 months usually. But in this case, most likely it is going to be a long-term loan, especially for business, not a personal loan, but a business loan. It's most likely going to be more than a year. Okay. And so what kind of account balance would this have?
A debit?
A debit, no. Okay. It's a liability. If you're going to owe somebody money and increase your loan, it would most likely be a credit balance. All right, what about owner's equity? The value of your company.
Would that just be owner's equity?
It would just be owner's equity. Okay. What kind of category would an equity account have?
A fixed?
What categories do owner's equity have?
None.
It
They
would
don't have it.
it would not have any categories. Good. So in this case, if it doesn't have a category, right, then what kind of balance would owner's equity normally have?
It's credit.
Credit, good. What about an owner's withdrawal? When you take money away from the company?
that be an expense?
Owner's withdrawal is not an expense.
It's non-equity. Is an equity. Correct.
It would be an equity because the owner is withdrawing from the company, right?
Yes.
So you're gonna be withdrawing from the company.
Mm-hmm.
So that would have no
No.
categories.
And
Now,
it's debit.
yes, because we're decreasing the value of the company. So you would normally debit the account, okay, if you're trying to decrease the value of the company. Okay. Let's see what's next. What about sales? What is sales? What kind of an account would sales be?
Revenue is an income.
Mm-hmm. Sales, right? This is how we generate income, is through revenues or income, whichever one that you want to use. Okay, I think in the exam I use revenues. Now, what kind of category would sales be?
Operating revenues.
Yes, it would be part of operating revenues, okay? If it just says sales, then that is also an option because we're looking at a merchandising activity. Sales is your main core of operations, okay? It's your operating core business of generating revenue, okay? So in this case, what kind of account balance would sales have?
Correct.
Yes, it would have a credit balance, okay? All right, 3 more to go. Number 13 here, cost of goods sold. What is cost of goods sold?
An income?
Cost of goods sold? Not in this case, right? It's directly correlated to inventory, yes, but it's not a means to generate income.
An asset?
It's definitely not an asset because in this case, it's the cost of goods sold. When you sell your items, right? How do you what account would you represent to get rid of those items?
An expense?
Yes, good. An expense. Now, what kind of expense is cost of goods sold?
A sale?
Okay. Is sales part is sales a category of expense? So I would highly recommend you use your review sheets because I listed out all the categories for each account type. Okay. So what kind of category would cost of goods sold fall under in expense?
Cost of
It's its own category itself. Cost Cost of goods sold.
Mhm.
Okay. And what kind of balance would that have?
Debit.
Yes. Yes. Expenses are always going to be debited. Increased or the normal balance of expenses will always be debit. Okay. What about rent expense? What about rent expense? What kind of account would rent expense have?
Which is an expense.
Yes, it is. Now, what kind of expense?
It's an operating expense.
Operating, right? It's not directly correlated to inventory, which is cost of goods sold. It is directly correlated to the operations, right? You need to have the building in order for you to open your store, in order for you to sell those items. So it's going to be part of operating. Okay? And what kind of balance would that have?
A debit?
A debit, yes. Okay. Okay. Last but not least, what about supplies expense?
Would that also be an expense?
Yes, it would definitely be an expense. Okay. Now, what kind of expense?
An operating expense?
Operating, yes, because in this case, it's not directly correlated to inventory, right? That's cost of goods sold. In this case, you may need to use you may need to use some supplies during your operations of your business, right? So in this case, it'd be operating. Okay. Last but not least, what kind of balance would this normally have?
A debit?
It would have a debit, yes. Okay. So here's a key few, ways to be able to determine what account is what. Most cases, anything with the term expense after it, it's obviously going to be an expense. Anything with the word payable, right, is going to be a liability. Okay. Um, as far as revenues, right, anything that has sales returns, just sales in general, that's most likely going to be a revenue. Okay. Now, as far as assets, if you think about it, just anything that you own. So, cash, is that something you own? Yes. Right? Land, it's something that you own? Yes. Okay. So, there you have it. Okay. Now, continuing on, number 9, what does left mean?
Debit.
It means debit. Good. What does right mean? Right. You only have so many answers that you could choose from.
A credit.
It means credit, yes. Okay. Number 11, okay? If your company had a total assets of 125,000 and a total liabilities of 45,000, what is your total owner's equity?
D, 80,000.
80,000, right? So in this case, this is where I'm going to be asking you the accounting equation. So if your assets equals liabilities plus equity, right? If it is 125,000 is equal to 45,000 plus X, you just solve for X, right? So in this case, 80,000 is correct. Okay. Number 13, number 12, okay? What account types normally have a debit balance?
See,
C, assets and expenses. Good. Okay. Number 13, okay? Which of the following account types are temporary accounts? Okay.
it's B.
B, revenues and expenses. Yes, that's correct. So in this case, right, when we refer to permanent and temporary accounts, the definition behind it is which accounts close at the end of a given period, right? If they're permanent accounts, right, they normally do not close out because think about it. Your assets, right? If you close out your assets, what's going to happen if you close out your bank account? It means like you stop doing business, right?
You close the business, right?
Right, you close the business, right? Same thing with equity. If you close out your equity account, that means your company has no value anymore. All right, if you take out all the money out of your company no longer has value. Okay, so therefore, that means you must have either sold the business or something happened, right? Where your temporary accounts, such as your revenues and your expenses, right? You can close them out because they're perfect ways to measure profitability, right? Because at the end of the day, you're not going to have the same reoccurring revenues every month. You're not going to have the same reoccurring expenses every month, right? So that's why you close your revenues and your expenses, right? You're trying to generate money for the business, and you're also trying to, you know, have your expenses in order to run your business. So in this case, those two ones are able to close out without having affecting the company at all, and that's why we call them temporary accounts because they temporarily close at the end of the given period. Okay. All right, now we're moving into chapter 3 here. Let me see real quick. Yeah, let's go ahead and go through the whole thing, and I think we'll just finish early today. Okay. So here, question number 14. When journalizing a transaction, which statement is true?
A, debits equals credits.
Yes, your debits must equal your credits, right? That's rule of thumb every time you do a journal entry, right? You're not looking at debits are recorded last, right? That's not true. You have to usually put those first. Credits are not recorded first. And then again, descriptions are account names only, which is not true, right? You can add as much details as you as long as you understand what happened in that transaction. Okay. Number 15, okay, what are the methods used for correcting errors in journals?
D, both A and B.
Yes, error cancellation and the B, which is reverse and reentry, right? I did not teach you the cross out method. Okay. Number 16, okay? You made a purchase of office supplies for $56, okay? Cash. Okay? And then you recorded it in your journal as office supplies for $65. Correct this error in the entry using both methods. So the first one is a reverse and reentry. So in this case, I originally recorded it at 65 when it's supposed to be 56. So how do I use the reverse and reentry to fix this transaction?
You enter the transaction first, no?
So in this case, we already did enter the transaction, right? We already entered it in as 65. Now we need to fix the error. So we already did the transaction there.
But you have to journalize the transaction. So you pay cash, right? $65.
Yes, but I already did that. I'm telling you to fix it. I already did that. I'm telling you to
Mm-hmm.
fix it because I already made the mistake and I recognized it. So how do I use the reverse and reentry to fix this journal entry? I've already done it. So I don't need to redo it again.
So you buy the office supply. You buy for $56. You do the entry for $56. Don't remember.
We bought it for 56,
Mm-hmm.
but I recorded it as 65.
So I'm not so sure. The other one is more easy. But this one, I don't know what I've done.
So in this
I'm not so
case,
sure.
we need to reverse the entry first. In this case, I've already done the entry, so now I need to reverse it. How do I reverse it? Okay,
Do we make a line for the expense and one for the accounts payable?
I use cash.
Oh, so one for the expense and then the second line as a cash
Okay,
credit?
that's all right, but that is you're entering the actual wrong transaction. In this case, I've already entered it in. So I will provide you a journal of you actually making the mistake in there. So I will have you entering in the mistake already. In this case, I'm asking you to fix it now.
So office supplies for $56 and cash for 56 on the credit side. I don't know why that's how it's right here. Not something like that.
No, because now you're entering in the mistake.
So I don't know.
I'm not asked. Okay, so in this case, right? I've already entered in my journal as office supplies for $56 or for $65 and cash for 65. Now I'm asking you because that's not true. I did not buy it for 65. I bought it for 56. How do I use the reverse and reentry method to fix my error?
The difference, the $9. Um,
Is that what the reverse and reentry does?
that's the cancellation.
That's
No,
the cancellation, correct?
the, the other one I'm not so sure. I don't know.
Okay, so remember, we went to the store, right? We purchased the office supplies, right? In my mind, I said that I spent $65. Now, in order to reverse the entry, I'm going to go back to the store and return those items and then buy it back. That's the reverse and reentry. So how do I return my office supplies? How do I reverse my transaction?
Do we go in and debit the $65 for office supplies?
Not for office supplies. Okay.
The, okay. The cash on the debit and the supplies on the credit for $65, and then you re-enter the purchase. So
Okay, good. Right?
it's like that.
It's exactly
Okay.
correct. Okay, so I've already entered in my books that it was 65. Now, the reverse to reverse that, I'm gonna go to the store and I'm gonna return it. So therefore, I should be getting cash back for $65, right?
Yes.
And then I would be returning my office supplies. Good.
Mm-hmm.
For those $65. Okay? And then the second
And then
part
you
of
buy it.
this, and then I'm going to repurchase it again. So office supplies. Okay? And cash, right? Because I spent cash. But I'm going to now enter in for the correct amount for $56. Yes. Okay. That's exactly correct. We're reversing the entry by returning, and then we're going to re-enter it for the correct amount. So that's the reverse and re-entry method, okay? So now let's go ahead and take the time to do the error cancellation method, okay? So what is the difference between 65 and 56?
$9.
$9, okay? So we know we have to put $9 somewhere, okay? So I'm going to go ahead and put this in here, $9, okay? Now let's take a look. I originally journalized it for $65, right? I said that I purchased my supplies for $65. But in reality, it's 56. So, which account is under and which account is over?
The supplies that are over and the cash is under.
Yes. Okay, so that means, so how am I going to, where am I going to place this $9?
So the first one is the cash, you in the debit.
Good, right? Because I spent too much money, so I'm gonna get $9 cash back. Good, and then I'm going to reduce my supplies by $9 because I have too much supplies. Excellent. Good.
That is more clear. That I can see. The
Okay.
other one was a little bit harder.
Okay. All right. Good. All right. Number 17. Okay. What is the difference between the general journal and the general ledger?
Is a C.
It is C, right? The ledger is a list of all the accounts with balances. Good. Okay. All right, chapter number 4, okay? Number 18 says, which of the following steps belong to the accounting cycle? Okay, so here's all the steps, all right? And then here are the options. Is it 1, 2, and 3 only? 4, 5, and 6 only? 7, 8, and 9, and 10 only? Or is it all of the above?
All of the above.
It is all of the above, okay? Now, of course, the exam is not going to be this easy, okay? I'm going to give you a series of scenarios. For example, I could say source document, general journal, um, analyze, and post closing, right? I can have that order, okay, on there. Okay? Good. All right, question number 19 says, which of the following is not a characteristic of financial statements?
B, reasonable.
Yes, of course, reasonable is not going to be one of those characteristics, right? Number 20, okay, under the rules of GAAP, which rule states that personal assets should be separated from business assets?
A.
A, business or economic entity. That's correct. That's the definition right there, is to make sure that you keep your personal and your business separate. Okay. Number 21, okay, under the rules of GAAP, which rule states that when recording a transaction, okay, it should be recorded in terms of money or value?
C.
C, monetary assumption, right? That's one of the rules, is that you must use some kind of form of currency. And rule number 2, the monetary measurement, which I'm not going to have you guys know, is basically says that you must record in terms of dollars, or in terms of the unit that you used, right? In terms of value, not quantity, but in terms of total cost. Okay. Number 22, okay, under the rules of GAAP, which rule states that when making purchases of assets, okay, they are recorded at original selling price, or this value does not change over time. So in this case, at fair market value.
It's B.
B, historical cost is correct, right? That one tells you if you buy a home for 100,000, it's going to be 100,000 10 years from now. Okay. Number 23, okay? Cash basis is when
It's D.
D, okay? A and B only. So let's see. Revenues are recognized when cash is received. B says expenses are recorded when cash is readily available to spend. And that's for cash basis, and that is correct. A and B only. Okay. Oops. Okay. And then here, last question is, what is accrual basis? Or accrual basis is when? which is C, yes. When expenses are recorded when it has been incurred. Yes. Okay. So once
That's a
again,
good.
go ahead.
You're gonna you're gonna give an answer like that.
Yeah, in this
That's good
case,
that I could.
I will be asking similar questions. Not exactly, but there, yes, this question is definitely on the exam. Okay. It's not word for word. It's going to be worded slightly different, but the concept and idea is still there. So again, as an accountant, right, we have to think of the many ways that this question could be asked, right? I could say accrual basis is when. This example is what accounting basis, right? If revenues are recognized when earned, what example of accounting basis is that? There's many ways that you can interpret a question. So this is just one of those questions that, again, it's not going to be identical on the exam, but it will definitely be asked on the exam. Okay. So as I mentioned before, the next couple sections or next couple questions are going to be for chapter 5 and 6. So again, I'm going to have that for tomorrow. So we have something to do tomorrow. So again, if you guys don't have any questions, again, please study, 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 study. And yeah, I can call it a day. So yeah, if you don't have any other extra questions.